Netflix is a sell. Due to Netflix's large cash expenditures to generate new content and their decreased ability to generate new subscribers due to competition, I believe that Netflix prospects looking forward are not very good. Looking at the market, Netflix is facing an incredible amount of competition from major players such as Disney, Apple, and Amazon. And going forward, this is going to limit the ability of Netflix to offer content, as is already the case, from Disney pulling their Marvel content from Netflix's platforms, and increase prices to put content from other producers on their platform because they'll have to compete with the likes of Amazon or Apple. My DCF analysis suggested that Netflix might have been undervalued in either the base or the bull cases, but I am very bearish on Netflix due to these factors. And my EV to EBITDA multiples suggested that Netflix perhaps deserves a lower valuation. Looking at Netflix's price graph, there have been a lot of news in the market lately that have created a lot of volatility in Netflix's price. And going forward, I believe that Netflix is going to continue to have a negative news cycle that will continue to beat down the price. They're going to have lower revenue from increased expenditures to generate content and from lower subscriber rates in the competition with these new players such as Disney, Amazon, or Apple. In choosing my WACC for my DCF models, I started out with a 10.7 in my base case, which is what was suggested from Bloomberg using a 5-year beta of about 1.46. And then in my bull case, I used a WACC of about 9.3%, which came from the unadjusted 6-month beta of about 1.2. I believed this was fair, and I used unadjusted beta in these cases because I was trying to get some more extreme cases of what was possible for Netflix. And in the bear case, I used the beta of about 1.6, which yielded a WACC of 11.4%, which was their unadjusted beta from the past year. Looking at my DCF models, in my base case, I assumed about 25% growth going forward, which was the middle of my 20% growth assumption in the low case coming from Bloomberg, and a 30% growth assumption, which was the 5-year average looking back. This yielded a valuation of about $374 per share. This suggests that Netflix is currently undervalued as it stands today. In my bull case, I assumed 30% growth going forward, as I said, from the 5-year average, and this yielded an incredible $580 per share. This reveals that perhaps Netflix could see incredible growth, that they were able to continue generating revenue at the pace that they have in the past with such incredible growth. I, however, don't believe this is possible because of their increase in expenditures and because of increased competition for new subscribers, which yielded my bear case of about 20% growth and the higher WACC. And this gave a stock price estimate of about $272 per share. Given that this is the case that I think is most likely looking forward, it suggests that Netflix's current price is actually overvalued and that it should drop even more. Looking at my multiples valuation, I started out with a bull case with a multiple of 12.32, which was from Netflix's named competitors. And my EBITDA was from my first year forecast at a 30% growth rate. This yielded a price of $315 per share. This suggests that perhaps Netflix is a little undervalued, but much less growth potential than what's suggested by the DCFs. My base case suggested that Netflix was currently overvalued with a stock price of about $257 per share. In this case, I used Hoover's as my multiple and their competitor list, which was kind of in the middle of what Bloomberg and Netflix themselves suggested. And I use a 25% growth rate for my EBITDA expectations. For my final bear case using multiples valuation, I used Bloomberg's competitor list multiple of 9.79 and my 20% growth assumption for EBITDA. This yielded a share value of $227 per share, suggesting that Netflix is very overvalued and has a lot of room to fall. I think it's fair to expect these kind of valuations from competitors, as there's so much increased competition in the subscriber market as so many new players come in, and that it's fair to expect Netflix to have a lower multiple going forward. That's all the concerns that they have. Now, looking at analyst recommendations, most analysts actually recommend that Netflix is a buy, with about 63% of them saying that it's a buy. So I'm kind of going against the grain of it here and suggest a target price of about $353, which is similar to what my DCF models say. But looking at some older reports, in one of the past sell arguments, I saw some concerns that I still think are concerns for Netflix moving forward. One is Netflix's ability to raise prices, as Albert Freud and company detailed that they did their own focus groups and found that Netflix had very limited ability to increase prices. And I think that's definitely true going forward, as there's even the new concerns from competitors in Netflix's ability to raise prices or to generate revenue from doing this, even though they're having to spend more to generate content. They also showed concerns about Netflix's international economics and their ability to generate revenue from subscribers abroad. And looking forward, I think that Netflix's subscriber growth, which appears to be the only driver of revenue growth that they have available, is going to be a concern. Netflix is going to be competing with Disney and Apple for each new subscriber. So someone who might have chosen to go with Netflix as they enter into streaming might now choose to go with Disney or Apple or Amazon as their first streaming service. And this is cause for concern going forward. Looking at one of the more bullish analysts from JP Morgan, Doug Anmuth gave Netflix a price target of $425 per share. He believed that from Netflix's ability to generate good content and popular films such as The Irishman, and that the Disney Plus launch was behind, that Netflix has a rosy outlook. They're going to be the beneficiary and driver of continued disruption of TV services as more people move from cable to only purchasing subscribers. I don't agree with this analysis. I think that Disney is going to continue to hurt Netflix as they go forward and generate new subscribers, as they're going to continue to steal new subscribers from Netflix. People who would have perhaps signed up for Netflix are now going to sign up for Disney. And so, in the end, I actually believe that Netflix is a sell and that Disney is a buy. They had an incredible offering of their streaming service, as many people signed up, and they're not having to spend a lot on new content. They have an incredible library of offerings that people want, and they're able to generate a lot of potential subscribers from their popular shows such as The Mandalorian, and this show has already become a cultural phenomenon. And I think that Disney is going to have a lot of growth in subscribers going forward as people want to get on the service, to experience these shows that they're creating, and to watch beloved old shows from the Disney library. Thank you.